In this video, I'm going to show you a simple strategy using Heikin Ashi candles. It helps you see the trend in the market and shows when the price may change direction. I also add RSI to make the strategy even stronger. If you want to make a smarter trades and stop losing money on false signals, stay tuned until the end. And make sure to hit that like button and subscribe right now so you never miss a powerful trading tip. What is Heikin Ashi? For beginners, or if you're not familiar with Heikin Ashi candles, let me explain quickly. At first glance, it might look like a normal candlestick chart, right? But Heikin Ashi works a little differently. The term Heikin Ashi means average bar in Japanese. Instead of showing the exact price for each candle, it calculates an average. This helps to smooth out the chart and remove a lot of the market noise. Why is this useful? Well, in real chart, price moves ups and down constantly. Small pullbacks and shadows can make it hard to see the real trend. Heikin Ashi makes trend much clearer because the candles are smooth. For example, in a strong uptrend, you'll see several green candles in a row with big bodies and no lower shadows. In a strong downtrend, several red candles in a row with big bodies and no upper shadows. So basically, Heikin Ashi helps you see the main trend without getting distracted by tiny price movements. One important thing, Heikin Ashi candles don't show the exact real-time price. They are averaged. So always remember that the real price is slightly different. When trading, looking at Heikin Ashi alongside the normal candlestick chart can be very powerful. You get the smooth trend from Heikin Ashi and the exact entry points from the normal chart. So in summary, the benefits of Heikin Ashi are trends become clearer, small pullbacks don't distract you, and false moves are filtered out. Now that you understand Heikin Ashi, let's see how to identify trends using these candles. How to identify trends and reversals with Heikin Ashi. With Heikin Ashi candles in mind, it's time to see how trends and reversals appear. For identifying trends, there are three simple rules. For an uptrend, the Heikin Ashi candles must be green. They must have large bodies. They should have no lower shadows. If all these rules are met, you have a strong uptrend. For a downtrend, it's the opposite. Candles must be red. They must have large bodies. They should have no upper shadows. Now let's see how to identify reversals with Heikin Ashi. After a strong trend, the price may slow down and start to reverse. Heikin Ashi makes these reversals easier to spot. Here are two steps to spot a reversal with Heikin Ashi. Step 1. Look for a doji candle. A doji candle has a small body with shadows on both sides. It can be green or red, and it shows indecision in the market. Step 2. Wait for confirmation. After a doji appears, wait for two big candles in the opposite direction. For a bullish reversal after a downtrend, look for two green candles with no lower shadows. For a bearish reversal after an uptrend, look for two red candles with no upper shadows. When these two candles appear, you have your entry signal. For example, here the price is in a downtrend. A doji candle forms. After that, two green candles appear with no lower shadows. This is your signal to go long. Or here, in the opposite direction, the market is in an uptrend. A doji candle forms. Then two red candles appear with no upper shadows. This is your signal to go short. That's how Heikin Ashi helps you clearly identify trends and potential reversal in a simple and reliable way. Introducing RSI. Now here's the problem. Heikin Ashi candles are great for showing trends, but sometimes they give early or false signals. This is where RSI, Relative Strength Index, comes in to help. Just a reminder, RSI moves between 0 and 100 and shows if the market is overbought or oversold. If RSI is above 70, the market is considered overbought, which means the price may stop rising soon or even reverse down. On the other hand, if RSI is below 30, the market is considered oversold, meaning the price may stop falling soon or even reverse up. RSI can do more than just showing overbought and oversold conditions. It can also show divergences, which are very useful for spotting reversals early. A bearish divergence happens during an uptrend when the price makes a higher high but RSI makes a lower high, showing that the uptrend may be losing strength. A bullish divergence happens during a downtrend when the price makes a lower low but RSI makes a higher low, indicating that the downtrend may be weakening. RSI can also help confirm Heikin Ashi signals. For example, if Heikin Ashi shows a potential reversal and RSI also shows a divergence or overbought and oversold conditions, the signal becomes stronger and more reliable. When you combine Heikin Ashi with RSI, you get clearer trends from Heikin Ashi, early warnings from RSI, fewer false signals, and better timing for your entries. Now let's see how to use these two indicators together in real trades. But before we move on, just a reminder. We have a separate video covering all types of divergences with details. I highly recommend watching that video. The link is in the description. Combining Heikin Ashi with RSI. Here's how this strategy using Heikin Ashi and RSI works. For a buy setup, first look for a clear downtrend. Then wait for a bullish reversal on Heikin Ashi candles. As we explained before, this means a doji candle followed by two strong green candles. Next, check RSI. It should either be below 30, showing the market is oversold, or showing a bullish divergence where RSI makes a higher low while the price makes a lower low. If both conditions are met, the Heikin Ashi reversal and the RSI signal, you can enter the trade. Place your stop loss just below the recent swing low to manage risk. For a sell setup, do the opposite. First look for a clear uptrend, then wait for a bearish reversal on Heikin Ashi candles. This means a doji candle followed by two strong red candles. Next, check RSI. It should either be above 70, showing the market is overbought, or showing a bearish divergence, where RSI makes a lower high, while the price makes a higher high. If both conditions are met, the Heikin Ashi reversal and the RSI signal, you can enter the trade. Place your stop loss just above the recent swing high to manage risk. This way, Heikin Ashi gives you clear signals of trend change and RSI filters out weak ones, making the strategy more reliable. Real market examples. Let's look at an example on Bitcoin chart. At first, the chart shows a strong uptrend with Heikin Ashi candles, long green bodies, and no lower shadows. That clearly signals buyers are in control. But when we check RSI, we notice something different. While the price keeps making higher high, RSI is making lower highs. This is called a bearish divergence, and it warns us the trend may be getting weaker. Soon after that, a doji candle forms, followed by two strong red candles on Heikin Ashi. That's the confirmation. This is a sell entry. You can enter the trade right after the second red candle closes. Place your stop loss just above the recent swing high because if the price breaks that level, the signal is invalid. And for take profit, use a 1:2 risk to reward ratio. As you can see, right after the signal, the price drops sharply and quickly, hits the take profit exactly as RSI warned us before. Let's look at an example on gold. At first, the chart shows a clear downtrend with Heikin Ashi candles, long red bodies, and no upper shadows. That clearly signals sellers are in control. But when we check RSI, we notice something interesting. While the price keeps making lower low, RSI is making higher low. This is called a bullish divergence, and it warns us the downtrend may be losing strength. Soon after that, a doji candle forms, followed by two strong green candles on Heikin Ashi. That's the confirmation. This is a buy entry. You can enter the trade right after the second green candle closes. Place your stop loss just below the recent swing low, because if the price breaks that level, the signal is invalid. And for take profit, use a 1:2 risk to reward ratio. As you can see, right after this signal, the price goes up strongly and quickly hits the take profit, exactly as RSI warned us before. So that's how you can combine Heikin Ashi with RSI to filter out false signals and catch high probability trades. So that's how you combine Heikin Ashi with RSI to filter out false signals and catch high probability trades. Heikin Ashi makes the trend clear, while RSI gives you the early warning signs. Together, they are a powerful combo for timing your entries and exits. If you find this strategy helpful, don't forget to give this video a like and subscribe to the channel for more practical trading setups. And if you want to go deeper, check out my next video about all types of RSI divergences. Until next time, happy trading!